What's up, boys and girls? Old Uncle Toot back again for the second day in a row. We're doing a 7-day, everyday upload challenge. All you need to do is hit that like button on this video so you can get tomorrow's video. We're shooting for a paltry, tiny, itty bitty little 30 likes on this video today to continue to upload tomorrow. Tomorrow, if we get enough likes, we're going to do a Bitcoin price analysis. So, big one there. And if we get that done, then we're going to pre-market Monday do basically a market outlook for the week and the trades that we're going to be looking for in the traditional markets. So we got 3 videos lined up for you. But since you gave me the likes that we asked for yesterday, 20 little tiny itty bitty likes, go ahead and smash that like button right now. But since you did like yesterday, we're going to change some lives today. Some of you might think that you're Elliottwave masters, and I think that even those of you that are listening to this now, this could benefit you greatly. This is going to be a very simple, quick little synopsis of what this theory is that we care about so much and how to trade it in the market. Change your freaking lives. We can do it together. Let's go. Oh, yeah, and we're going to do it in 10 minutes or less. Let's see if we can do it. Okay, guys, 10 minutes to change your lives. Let's see if I can do it. Deep breaths. And go. All right, the wave theory is a concept developed by Ralph Nelson Elliott in the late 20s, early 30s. He published his book called The Wave Principle in the early 1930s. It didn't get too much traction it did get some, but not the broad traction it has now in the financial markets and the popularity until the 70s, when a book was written by Frost and Prechter called the Elliottwave Principle. Those people then started the Elliottwave International, which is basically now the de facto primary governing body of the theory. They are the authority. The book is quite good. However, you can teach an entire college course, if not an entire major, on this theory, and you just can't capture everything in a little skinny little book. So they had an educational section ran by Wayne Gorman for very many years, who has since retired. And Wayne Gorman wrote a book with Jeffrey Kennedy called Trading Elliott Wave. Great book. But what was even greater for my learning and personal growth from Wayne Gorman was an open Q&A forum at EWI for anybody that was certified, and you could ask questions and have interaction with them in that way. However, when Wayne retired, that is now defunct. So if you want to learn what the God, Wayne Gorman, taught everyone, or the few that were there, then you have to learn from people like me. Old Uncle Tutu is a CWEAM, which is Certified Elliott Wave Analyst, Master Designation through EWI. I have been professionally teaching this Elliottwave Principle for like 5 years. So let's go. Elliott theorized that the market trends in 5 waves and corrects in 3 waves. Okay, so this is in the trending waves are motive waves, and the corrective waves are the correcting waves are called corrective waves, and they are 3 waves. There's 2 styles of corrective, sideways and sharp. A sideways would have a B that goes something like this. However, for this early trade idea, we will only focus on sideways. All right, so what we really are going to want to focus on in this trade that I'm going to show you is a finished correction. And the way that we determine if a correction is finished is if it's adequate off of a motive wave. So one way we'll do that is we will draw what's called a final channel. We will go from wave 2 to wave 4 with our channeling tool from wave 3. This is your final channel. An adequate retracement should break this final channel. It'll most usually retrace between 50% and 618% of the motive wave, and it'll usually end in the area of wave 4 of 1 lesser degree, most typically at the terminus, at the end. These are the things that we are looking for that finished corrective move. Another thing that we can do is in the corrective move, for the sharp corrective move, we can draw a channel called a base channel from the origin of the correction, and in this case, an ABC zigzag from the origin from the B and then from the A. And then we will look for that C to project and be contained for the bottom of the channel, and it should be contained within there. These are the things we're looking for a finished, adequate correction. Not only adequate, but finished. Okay? depending on the shape and the style of the market, you may also use the median. You're going to have to figure out this determination. Maybe the 50, maybe the median in the logical area for the end would be, right between the high probable area between a 50 and a 618 is the high probable area for one of these corrections to go. Actually, and it could really even go to consider between the high probable area between the 50 and the 786. And this is just your Fibonacci retracement tool. Not going to get into how to use that today. Okay, so the theory, we move in fives, the market trends in fives, corrects in threes. The natural state of the market is up. Just go on any chart, go out to the weekly, monthly, zoom out, and you'll see any major index, Bitcoin, whatever it may be, that the natural state of the market is up. However, it is a fractal market. And in each one of these waves that we see here, you will see the whole representation of this. So you'll see 5 waves, 3 waves, 5 waves, 3 waves, 5 waves, 3 waves. And each one of those will then infinitely divide, right? All the way until we can make it out. So that is the fractal nature of the market. Okay, so what we're going to look to do is to long contextually on a larger degree than we're looking at here, where we will say have a move coming down where this 5-wave impulse is not an adequate retracement. And then we will look, and we know that it can't be a finished corrective also if it's inadequate and it's a 5-wave move, because it can't be a corrective move if it's 5 waves. So we will look for 5 waves, and then we will look for 3 waves to be finished. We will enter a long trade, and then we will take profits. Okay, so when are we going to enter? Typically, we will want to enter once we have hit the signpost of first, we're only going to concern ourselves with sharp corrections. If it's not sharp, we don't want it. Second, we want it contained within the base channel, and we want it to either be finishing around the median, depending on the slope and the way everything looks, or the bottom of the base trend. We want it to be between the 50 and the 618, and we want it to be at least in the area of the bottom of the previous wave 4. Those are the things we're going to look at to enter. And then, based on that entry area, we are going to project. So we'll use our Fibonacci projection tool, the length of the impulse that we're trading from to where, let's just say wherever the projected bottom to finish is at the time that we're going to take our trade. And then our projection for our trade target will just be a simple 1-to-1 projection of that motive. So, and when that happens, we will then look for basically our stop loss at the time we're taking the trade to be below the 786. This gives us some leeway, and we want this trade to be at least 3-to-1. We want this to be at least 3-to-1 to take it. Now, what's the most important part is if we're going to take a stop loss on this trade, and we need to size appropriately and do all these other things that I just don't have time to tell you about. But if we take a stop loss, it will be because we have gone below the 786, we have broken out of the base trend channel, or something else happens that makes it very atypical. But primarily, if we break out of the base channel, or if we go below the 786 in the retracement, we are going to take our stop loss. And then this is our primary projection for a target. However, we're going to leave that 1-to-1. We're going to do the same thing we did for the zigzag on the way down with the channel. And we're going to use that, and we have the middle on there as well. So we will look for this to project to the top of the base channel. If it hits the top of the base channel and the move could be 5 waves completed before the 1-to-1, we're going to go ahead and take it. We're also going to look at the negative 0.236 on our Fibonacci retracement tool as a place where we're going to see a finished wave potentially finishing up. And we're not just hitting these signposts and calling it a day. We're looking for 5 waves, just like we're looking for a finish on this. And there's really a million other things that we can do to clean this up, make it tighter, make that risk to reward that I showed way even, super tight, and not only be super tight, because a lot of times you see people do this and like, oh, I got a 32-to-1 risk to reward trade. Yeah, but usually they're doing that and they have 0 probability of expectation to actually make a winner. Stick with me and we'll get you to be able to make these little tight trades. But for now, this is all you need to know about Elliottwave. Everything we covered here Market moves in fives, corrects in threes. We're going to look to take the long trade based on an inadequate 5-wave move after some other large move. Doesn't matter what it is contextually, and you can do this both ways in the market, up and down, but it's going to be inadequate to an inadequate retracement of whatever this has been. It's going to be 5 waves because we know that can't be a corrective. We're going to look for a finished 3-wave sharp zigzag off of it. Could be a multiple zigzag. Don't care. If you don't know what that is, don't worry about it. We're going to look for it to be contained within this base channel. And we're going to be looking for, of course, 5-3, finishing 5 to go between the 50 and the 618. We're going to want all these things to happen to take our long trade. And once we do, if we break out of the base containment channel or we go below the 786, we're going to go ahead and get the heck out of the trade. And we're going to cut our losses. And we're going to make sure that it's at least, again, once we have it finished and we're taking our entry area, that we're at least a 3-to-1 risk to reward ratio with a 1-to-1 projection. This is majorly important. You know, if you enter it here and the thing's there, then you got to draw your risk to reward at the time. Okay. And of course, we're going to have tight money management. If you just do this simple trade in the markets, you will do very well for yourselves. All right. I think I did it within 10 minutes. All right, so I really do believe that can help change your life in trading. And to be honest, there's so much more that I wanted to fit into that 10 minutes, but you can only do so much. And I think that is a really good base foundation for you guys. And, you know, just stick with me if you want to know more. Like I said, I could teach easily an advanced college course on this, if not figure out an entire major, because there's a lot to do with this theory and trading in the markets. And, you know, big part of this theory is incorporating other techniques that just work so well in confluence with it. I mean, it's just, there's so much, right? So I really think that this is great, and hope that you enjoy it. And, you know, if you got a question or if you want to see more content like this, hit me up in the comments. Again, 30 likes and we'll get a video update tomorrow. Tomorrow would be a nice typical standard price, Elliottwave price analysis. And yeah, guys, I hope you enjoyed it.